Well, good morning and welcome. I'm Anthony Barr, the Research and Impact Director here at the National Bankers Association and its supporting foundation. We're a 97-year-old trade representing the nation's mission-driven minority banks, and we support this vital sector through public policy advocacy, programs, and partnerships. Speaking of partnerships, I want to thank Visa's Economic Empowering Institute and Georgetown Law for helping co-host today's event. And I'd also like to thank the Kresge Foundation for their financial support for some of the research that we'll highlight today. We all know that homeownership is important, and yet the racial homeownership gap is larger today than it was in the 1960s. So in this event, we're excited to explore how minority banks are tackling that gap and increasing home ownership for communities of color. Ultimately, our goal as we celebrate this Juneteenth is to find new ways to strengthen our communities, close the racial wealth gap, and unlock economic mobility for underserved households. So we look forward to the insights that will be shared in today's event and the ongoing conversations and partnerships that this event will hopefully inspire. Now, we have a packed agenda today, including a presentation on the latest research, a fireside chat with officials at HUD and FHFA. But first, we'll hear from the Honorable Emanuel Cleaver, a longstanding affordable housing advocate who will provide opening remarks. As ranking member of the Housing and Insurance Subcommittee, in 2016, Representative Cleaver co-authored the largest sweeping reform bill on housing in 20 years. That bill, the Housing Opportunity Through Modernization Act, was bipartisan and passed into law with unanimous vote. So thank you so much, Representative Cleaver, for joining us today, and I'll kick it over to you.
All right, thank you very, very much for inviting me to be with you. I am delighted to do this for a number of reasons. One, I was born and raised in Texas, and so we in Texas, it is a state law that you have to learn Texas history, and so we have you have to pass two classes in state history, and so. We were taught things in Booker T. Washington High School that might not have been taught in other schools around the state of Texas. But as everyone knows, I think, or most people know, that and certainly they do in Texas, the reason we're celebrating this is because of General Gordon Granger. Now, General Granger sailed into Galveston and started putting signs up on trees on June 19th that slaves were free. But he went all over posting General Order Number 3, which declared slavery to be ended. However, before we get into this other portion of this, I need to let you know he is not a hero. General Granger was relieved of duty a short time afterward, and he spent his time counseling slaves, including my great grandfather, Pledge Cleaver, who was living in an all-black town called Ponte, and another one called Pine Hill down in East Texas, not too far from Jacksonville, Texas, or Tyler, Texas. And they were told to go back to the Cleaver farm, owned by Henry Cleaver, and sign a work agreement, and not to try to leave and go to a city or anything. Stay right where you are, and then try to get an agreement. Thank God my great grandfather Pledge did not do that. Now you have to understand they left slavery and they had no housing, so they built shacks. I have a photograph of my great grandfather Frank Harrison Cleaver. They took the name of Cleaver. Sometimes I get angry over that, but that's another old issue. They built a shack, and I have a photograph of the shack with Grandpa, my great grandpa Frank Harrison, and my great grandmother, who was Alice Fuller, who became Alice Cleaver. And so they had a shack, and in many ways we haven't gone too far away from the situation as it was on June 19th, and trying to figure out how we could have adequate housing. And so right now, at this very moment, home ownership is evasive for African Americans, and home ownership is critically important. It not only financially overperforms stocks and bonds as an investment, but they also provide economic security in times of instability, economic instability. But more even, it is critically important that we understand that without home ownership, we're going to have a most difficult time ever competing economically with any other groups. Right now, home ownership for white households is 75%. Think about this on June 19th, 75% for whites and 45% for the descendants of my great grandfather Pledge and his friends. We're at 45% for Black households. 6 decades now after fair housing was signed into law, the situation is still unacceptable. We're still struggling, and affordable housing is the most significant problem that Americans face. But if you're Black and brown, it is a crisis. And I want to thank my colleague, Maxine Waters, who has been a Tasmanian monster as it relates to the home ownership issues. And the freedom she gave me as the chair of the housing subcommittee was what also motivated me to work with Blaine Luetkemeyer to pass a bipartisan bill that dealt with some of the issues that I'm talking about. But let me close by saying this. We know what to do. President Biden invited me to the White House about 8 days after he was installed. I met in the office with his staff and with 4 members of the Senate, and he made it very clear that he was going to push to get a bill out called Build Back Better. And we went through some of the early ideas he had for that piece of legislation. And as you know, that bill was introduced. And painfully, I have to tell you that we lost by 2 votes. Ladies and gentlemen, on June 19th, keep in mind, that would have been the most revolutionary housing effort in the United States ever. And we weren't able to get it through. I'm hoping that something will happen that would allow us to maybe get it through next year. It is going to be something that I'm irreversibly committed to having to pushing, and I hope that those of you who are involved in housing will, in some ways, do your part by just talking about what we have to do, and then looking at that piece of legislation and picking out sections that you know will work. Thank you so much for having me, and God bless you. Happy Juneteenth.
Thank you so much, Representative Cleaver, for those stirring remarks and for providing the sense of urgency that undergirds, I think, the commitments that we bring to this event and the spirit in which we're engaging this. I think it was an amazing way for us to start. We're going to jump now into a research panel looking at some research around MDIs and home ownership. And I'm excited today to be joined by Jake Levy from the Visa Economic Empowering Institute. So we'll look at 2 papers that we've recently been researching. But before we do that, I want to set the stage by talking a little bit about the MDI sector. And so if you're not familiar, Minority Depository Institutions are minority banks that serve minority-majority communities. The FDIC defines them as institutions in which 51% of the voting stock is owned by minority individuals, or a majority of the board of directors is minority in the community that the institution serves as minority. And as we know from previous research from FDIC and others, that is exactly how the mission plays out. These are banks that locate in minority communities, often low-income communities, and these are the populations that they work with day in and day out. As of Q1 of this year, there are 150 MDIs with a total of $350 billion in assets. So it's a tiny fraction of the overall banking sector, but punches above its weight in terms of its social impact, which we'll see today. So, Jake, let's get started with your research. I want to hear a little bit about what your motivation was behind the topics that you were looking at, what you were excited to explore, and then we can jump into your methodology and findings.
Thanks, Anthony. Before I dive into the motivation behind our research, I just want to take a moment to thank Representative Cleaver and all the other participants in today's event. It's an honor to be featured alongside such a distinguished group of people, and I hope that the research I present today can help to shed just a little bit of light on the important work that that MDIs do across the country. Also, want to thank Georgetown Law and the National Bankers Association for co-hosting this event today. So, beyond amplifying the important work of MDIs, there are a couple of motivations behind this research. I would say more narrowly, we wanted to explore MDI's relationship to housing because, as Representative Cleaver alluded to, housing can be a really important driver of wealth and financial stability for individuals and communities, which we'll talk a little bit more about later on. And in a broader sense, the Visa Economic Empowerment Institute strives to tell compelling stories using Visa data. And this research presented an opportunity to do just that by leveraging depersonalized data on over 400,000 Visa credit card holders. So how did we conduct this research? Well, we started by pulling a sample of all of the individuals on Visa's network who have a credit card that's issued by an MDI. And we sort of consider those individuals our treatment group. And once we had the sample of MDI cardholders, we randomly selected a sample of non-MDI cardholders matching on demographic data from TransUnion. And so that second group sort of served as our control group. And once we had both the treatment and control groups, we calculated the percentage of homeowners within each group across several demographic categories.
That's a really, really awesome use of your data, and really excited to see the partnership with TransUnion as well, leveraging that data for insights. So I'm curious, before you get into the findings, if you had kind of any expectations or hypotheses about, what the data might tell you.
Yeah, absolutely. So I think in terms of MDI and non-MDI customers on the whole, there's quite a bit of research that's establishing that MDIs, often do business in neighborhoods that are low income, vulnerable communities. And so while we may expect sort of in a broader sense for non-MDI cardholders to display higher rates of homeownership, we wanted to take a look among different groups like age groups, income brackets to see how those played out sort of in a more specific settings.
Excellent. So let's jump in. What were some of your findings?
Sure thing. So when we broke out the sample by estimated household income, a couple of interesting findings emerged. As you can see on a screen here, among both MDI and non-MDI cardholders, the likelihood of owning a home increases with household income. So, this is in line with both conventional wisdom and prior research, but the really interesting findings begin to emerge when we compare MDI cardholders and non-MDI cardholders. So if you take a look at the two lowest income groups in our sample here, which are those with the red box around them. Now these encompass all the individuals in our sample with an annual household income of less than $45,000. And one thing you'll notice is that MDI cardholders, who are represented by the blue bar here, are more likely to own a home than those with cards issued by non-MDIs, and at statistically significant levels. And so this is really interesting. And although the finding isn't necessarily sufficient to establish a causal relationship between owning a credit card issued by an MDI and owning a home, we speculate that this finding is driven by the special relationship that MDIs have with their customers. Now, in other words, because MDIs have close relationships often with their customers and communities, they may be better able to assess the default risk of individuals whose income isn't sufficient to secure a home loan elsewhere.
Excellent. And then I know that you have some additional findings where you start looking at it by race. Is that correct?
Yeah, absolutely. If we can just take a look at the next slide here, you'll see our findings by income among only the Black American cardholders in our sample. Now, before I dive into the findings here, I think it's worth noting that we took a look at rates of homeownership among a number of different racial groups. And among Asian Americans and Native Americans, breaking out rates of home ownership by household income didn't yield particularly meaningful results. However, among both the Black and Hispanic Americans in our sample, we see a couple of really interesting things. And so if you take a look at the figure on screen, once again, these are our findings among Black American credit card holders. You'll see two notable differences from the figure on the previous slide. One is that the gap in home ownership between MDI and non-MDI customers remains statistically significant for the 4 lowest income groups, as opposed to just 2, encompassing all of those making below $70,000 annually. And the other interesting thing that you'll notice is that within each of these income groups, the gap in homeownership between MDI and non-MDI customers is wider than among the full sample. So just zeroing in on the lowest income group here, encompassing those making below $35,000 a year, you can see that Black American MDI cardholders are 9.2% more likely to own a home than non-MDI cardholders, compared to a difference of only about 3.1% among the full sample. So this is super interesting and just goes to show the important work that MDIs do in low-income Black American communities in the U.S.
Yeah, this is essential. It strikes me that this really underscores the importance of looking at race and income separately and together, right? Because you're telling a story here that says, there may be, there may be additional frictions around discrimination, that certain borrowers are going to experience. There may be, on the other hand, as you said, the comparative advantage of these MDIs and their deep relational knowledge of borrowers and contexts that are allowing them to extend, and really amplify the home ownership. So that's really exciting research. So I'm curious, if as you're kind of summing up what you've done, if there's gaps or limitations or areas of future research that you would want to kind of build on what you've done here.
Yeah, absolutely. So there are a couple different limitations to our research here, which I think is worth highlighting. One is that our sample includes only individuals who have a credit card, which biases our sample a bit. So there's prior research that has illustrated that credit card use increases with age, education, and income. So you can imagine that if our sample included debit card holders, individuals who only had access to a basic transaction account and not a credit card, the demographics may look a little bit different. And one other limitation is that although this study investigates homeownership, it doesn't specifically look at the mortgage lending activity of MDIs. However, Anthony, I believe the National Bankers Association has some recent research that does, so we'd be super curious to hear those findings.
It's almost like we've been practicing that transition. No, that's perfect. That completely sets up exactly what we worked on. And so what we did at the National Bankers Association and in collaboration with Hip Hop Caucus and Bank Black USA is we took HMDA data, which is the publicly reporting data that comes out of the legislation Representative Cleaver mentioned, the fair housing, et cetera, to really kind of apply accountability and pressure to the banking sector. So, we took that public data and looked at the pandemic period of 2019 to 2022. This also maps onto the Federal Reserve's survey where we get the racial wealth gap statistics and where they show that homeownership is a key driver of wealth. And so this is the period in time that we looked at. We're able to compare MDI lending against non-MDI lending and then look at very specific financial types as well and do that comparison. And so I'll jump into this next slide of just kind of key findings, setting the stage. 65 MDIs issued mortgages during this time period. So that's representing about nearly half, 43% of the MDIs that were present during that period. And they issued around 164,000 mortgages and nearly 58 billion in originations. Now, our sample is a little bit smaller when we actually do the analysis, and that's just based on looking at just conventional loans instead of government-backed FHA, USAID, et cetera. That allows for more apples to apples comparison. And what we find in that analysis is that MDIs originated a higher share of their mortgages to minority borrowers and to minority communities than did non-MDIs. MDIs also have lower denial rates and higher interest rates. Jake, you mentioned kind of the ability to increase financial inclusion through that relationship piece, and I think that's reflected in those lower denial rates. Higher interest rates can reflect, the less collateral, lower income, higher debt to income, other risk factors that get priced into the interest rate. And then the final finding that we'll highlight today is that communities that received MDI mortgage lending face disproportionate climate risk. So let's jump into a few of these findings, and we'll start with this slide here. What you see in each of these boxes is the share of loans that are going to each of the race and ethnicity groups that are listed at the bottom of the graph. And you can see that across each of the years, MDIs outperformed non-MDIs as a whole, community banks, CDFIs, top 25 in terms of asset size, fintechs, and credit unions in the share of loans that are going to minority borrowers. So specifically, 58% of MDI mortgages during this period went to a minority borrower versus only 27% of non-MDI mortgages. And then in the next slide, we took kind of that same framework, but we looked at minority communities. We used census data to look at the census tracts of where those loans are going, and similarly found that MDIs outperformed all other financial types in the share of lending going to majority minority census tracts. So again, over this 4-year period, 39% of these loans are going to minority majority census tracts versus only 21% of non-MDI loans. And I'll say this is actually even more substantial than it might appear, because a big part of our lending sample were native lenders, and there's far fewer native majority zip codes in the US. And so, to the extent that we're maybe understating kind of the direct impact of the lending to communities that are served by the mission of these institutions. And then in our third finding, we look at income. And so this is specifically the share of loans to low and moderate income communities. We have a similar breakdown of income of borrowers, but it's a little messy as a graph to kind of display on a screen here, but you can see it in our larger report. But again, find that MDIs and CDFIs are outperforming other financial types in the share of lending going to low and moderate income communities. I'll flag that CDFIs in particular shine here, and that also reflects that there's a lot of CDFI lending to rural communities, persistent poverty counties, and things of that nature. And then finally, on the climate side, the way that we did this is we took FEMA's risk framework, where they assign a risk score to all the communities throughout the U.S. based on 18 risk factors. So wildfire, earthquakes, flooding, extreme wind, things of that nature. And so what we find when we do this analysis is that places that received mortgages from MDIs have higher climate risk relative to places that received non-MDI mortgage lending. And if you take the two highest risk bands, basically, and look at the share of lending going there, 17% of MDI loans are going to those high-risk communities versus only 14% of the non-MDI loans. So, and similar to what you would expect, Hispanic, Black, and Native MDI lending are going to places that have even more elevated climate risk relative to the non-MDI lending. So that's important because on the one hand, it speaks to the mission of MDIs in serving vulnerable communities, as Jake mentioned, but it also serves to kind of warn about the risk that needs to be mitigated in terms of higher insurance costs, property damage that can affect your ability to build wealth and things of that nature. So I know I ran through a whole lot, but I'll just quickly summarize to say this fits with prior research from FDIC and others about the way in which MDIs are serving minority borrowers and minority communities, and it also points to kind of the increased capacity for tackling the wealth gap if we were able to, dramatically upscale the number of loans that the sector is able to do. And so that's something that we can talk about toward the end of this session. But Jake, I want to pause there and just see, what are some initial reactions that you would have or things that are standing out to you in terms of why homeownership is so important?
Absolutely. Thanks, Anthony. I think the findings of both of these studies taken together really just go to show the important work that MDIs do promoting homeownership in vulnerable communities in the U.S. Now, why is homeownership so important? So, as Representative Cleaver alluded to at the beginning, homeownership can be a really important vehicle for generating wealth and maintaining financial stability. Under the right economic conditions, the rate of return on home equity can outpace stocks, bonds, and other investments. So, just a really important driver of wealth in that sense. And previous research has also found that in many cases, that housing wealth is the only form of wealth possessed by low income and minority households. And beyond the sort of short and long term financial benefits of homeownership, it's been shown that owning a home can also drive positive outcomes in one's family and in one's community. There have been numerous studies investigating outcomes among the children of homeowners, and they've been shown to achieve higher educational outcomes than the children of individuals who don't own a home. And so that's just one interesting way that owning a home can benefit not only individuals, but their families as well. And to take an even broader look, there's also a growing body of evidence about the benefits of homeownership for communities as well. Prior research has found that homeowners tend to move less frequently than renters. They stay in the same place for a longer time. And this can result in positive outcomes such as, increased volunteer activity in a particular area and, higher turnout in local elections and that sort of thing. So not only does home ownership promote positive outcomes among individuals and their families, but also helps to drive civic participation and other fascinating community level outcomes.
Well, excellent, Jake. And I know that really starts to underscore kind of this community development lens that I know a lot of us are bringing to the table, and the power, as you're saying, to kind of unlock intergenerational benefits and communal benefits that spill across time. And so one final slide that I do want to highlight is the qualitative component of our interviews and of our research. We did interviews with 7 MDI, including loan officers and leaders and a variety of other key personnel. And so I'm not going to read everything that's on the slide, but I really do encourage folks to look at the report. There's a wealth of insight that they're sharing. The one thing I do want to highlight is this top insight around portfolio loans. So, when you originate a loan as a mortgage, some of those loans can be sold onto the secondary market, including to Fannie and Freddie, which are the government-sponsored enterprises. But when you originate to sell on the secondary market, you have to follow very specific, strict underwriting standards around debt to income, around the credit score, some of those other things. Whereas when you originate something to keep on your books, 15, 30-year mortgage, the institution is able to have more flexible underwriting. And so a number of our interviewees talked about the power of being able to look beyond a lower credit score and understand that, a history of rent payments and utility payments and other things of that nature can still identify safe and sound lending and allow you to increase that financial inclusion, make that loan to a borrower that might not otherwise qualify. But to that point about growing the capacity of the sector to do this kind of lending, when you're keeping it on your books, that's tying up the capital that you have, which limits your ability to do more lending. And so being able to drive in, new capital and build the balance sheet of our institutions is going to enable more of that kind of portfolio lending. But, thinking through some of the ways in which, other stakeholders can partner, and that's something that I'm hoping that will come out as a takeaway from this event, is thinking about, okay, how do we amplify that mission based on understanding what it is that the MDIs are doing. But I'm curious if there are any topics from this slide that stood out to you, Jake, or any kind of closing things that you want to say about this portion of the research.
Yeah, so one topic that stands out to me, Anthony, is the importance of digitalization and technology for MDIs. We live in a world where banking customers, demand a lot of digital services like online banking. And that's one of the reasons why Visa supports programs like the National Bankers Association's Connect Tech initiative, as well as others. And so we'll hear a little bit more about the work that Visa does with MDIs during the closing remarks for today's event. But first, we are going I'm going to pass it over to Chris Brummer from Georgetown Law, who'll be conducting a fireside chat with a couple of panelists who I'm very, very excited to hear from. So Chris, I'll go ahead and pass it over to you.
All right. Well, thank you so much for really such an interesting conversation, and one where, frankly, I learned a lot, and it really underscored the importance of the issues that we'll be talking about right now on this really interesting leaders panel with two people who are really at the forefront of policy development when it comes to housing. Adrienne Toddman, the acting director of HUD. Oh, I hear an echo, just for whatever it's worth. So we're going to be, so I'm very delighted to be able to have a conversation with really two people who are really at the forefront of policy development when it comes to housing and making some of those statistics real and improving them. And that includes Adrienne Toddman, the acting director of HUD, and Sandra Thompson, the director of the Federal Housing Finance Agency. I am a professor of law, again, over at the Georgetown University Law Center, where a lot of my work focuses on fintech and also financial inclusion. First, I guess I want to welcome you both to the program, and thanks so much for joining us.
Hello, can you hear me?
We can hear you. We can hear you.
Wonderful.
Great. Thank you so much, Acting Director, and obviously our Acting Secretary and obviously Director Thompson. It's so great to see you again.
You too.
Okay, I guess we'll just start off with this idea of how your respective agencies play a role in the landscape of housing. I think it really is a question that a lot of people would assume to be self-evident, but I think that just the way in which the agencies work and really the myriad sort of tools can be a little bit surprising. So maybe I'll, Acting Secretary, I'll just start with you to sort of talk about housing and really how your department promotes it.
Great, thank you so much, and thank you all for inviting me and our fabulous director of FHFA to this very important forum. I will say at the start that HUD and FHFA have never worked as closely together as we are now in the history of both organizations. So it's great to have her with me, and great that you all have invited us on this very critical issue. So, a lot of folks, when they think about HUD, immediately it goes into probably two buckets, depending upon your approach. Some folks go straight to, well, they're the public housing folks and the Section 8 folks. And some folks then who are very familiar with housing finance will go, well, they're also the FHA folks and the Jenny Mae folks. And so that's a part of our work that I'll focus on now. And, the number one thing that we do that I think will be of interest to this particular audience is just how much we channel global capital into the nation's housing markets with the leadership over at Jenny Mae. And that's what they do. And Director Thompson will talk a lot about her shop and what the GSEs do. But we are really holding up and the underpinning of making sure that we are creating liquidity and access to affordable homeownership for the many Americans out there who come and use our tools. And those tend to be predominantly Black and Brown people who may not compete well in the conventional market or are looking for just a slightly better terms that the FHA mortgage insurance product can provide them. It's also loans that we do for veterans and their homeownership program, and for our friends over in rural homeownership with our friends at USD as well. And so the work of Jenny Mae really is the underpinning of so much of what the federal government's real investment in affordable housing. But then we have the more transactional side, and that's where our partners at FHA come into play to make sure that we are insuring mortgages, doing smart underwriting. And as I mentioned, one of the things that we're really proud of in this administration is we have the highest rate of first-time home ownership in 20 years. And we're in this topsy-turvy roller coaster market that we're in, very proud of that and the work that we've done to help with making sure that there is an increase and improved rate of Black homeownership as well. And we share these successes with our sister agency, literally right across the street with FHFA. I want to hear what Sister Sandra has to say, but I'm sure there's more we'll get into about our work.
Great. That is fantastic. And obviously over at Fannie Mae, I've seen some of Director Thompson's wonderful work. But for those who may not be able to see that work every day, maybe you can get into the nature of that work and to also kind of talk about that question of capital and why it's so important, and the liquidity to the markets in terms of really delivering on the housing mandate.
Right. So thank you, Chris. I keep hearing an echo. Are you guys hearing one?
No, you sound great.
Okay, great.
Okay.
So before I get into the FHFA's role in the housing ecosystem, I really do want to acknowledge the work that MDIs play in fostering financial inclusion by serving historically marginalized communities, especially those of color. I want to just describe, for those who don't know, what FHFA does. So we serve as the regulator and conservator of Fannie Mae, Freddie Mac, and we're the regulator of the 11 federal home loan banks. Congress established our agency in 2008 after the great financial crisis, and its purpose was really to protect the safety and soundness of the housing finance system and promote affordable and sustainable access to credit nationwide from the conventional perspective. We provide more than $8.6 trillion in funding for the U.S. mortgage markets, and it has really been quite an experience. Certainly, we have not seen economics and markets like we've seen today. The housing affordability challenges are presenting significant barriers throughout the country to both renters and to those seeking to purchase a home. You know, housing prices have soared in the past few years. Mortgage rates have climbed well above their prehistoric lows. And we've got an unusually low supply of homes for sale, especially in the past few years. And that's really exacerbated some of the affordability issues. And it certainly disproportionately impacts credit-worthy potential first-time home buyers who are really struggling to achieve home ownership, but who often lack the resources to make a large down payment. You know, capital is critical, but liquidity is even more critical. And what I wanted to do is just try to establish a relationship today with some of the MDIs, because when I talked to Fannie and Freddie as late as yesterday, when I looked at the MDIs who are participating on the sell side and who actually sell to Fannie and Freddie, there aren't very many. And if there are these institutions, they're credit unions. Now, on the home loan bank side, it's a little different, and they do have flexibilities, but we really want to figure out ways to work more closely with Fannie and Freddie so that you don't have to keep those mortgages on the balance sheet, and you can use that money to provide liquidity and provide more funding for homes.
That is just fantastic. I mean, Nicole Elam and I, we started this series for Juneteenth a couple of years ago to really think about Black banks, and every year we've had a series of leaders like yourselves to kind of sit through and think about these institutions that are these critical anchors to their communities and can do so much to really level the playing field and provide for people who have been on the margins. I was struck, and this is just a sort of an impromptu kind of a question, as I think about all the, from Maxine Waters to the acting comptroller, we've had lots of people every year, that kind of coordination between the departments to kind of unlock those opportunities and to really, have one agency sort of think about what's happening in terms of sort of entities that can help it out in terms of its mission. I'm a little bit curious as to how that kind of works, and what more do you think governments can do when it comes towards sort of enabling these kinds of opportunities? So, Acting Secretary, I guess I'll start with you.
Thank you. And I'm going to take the conversation and answering this question probably slightly away from just HUD to the work that HUD has been doing with our other federal family agencies as it relates to the billions and billions of historic funds that this president has been able to secure for the country from the Infrastructure Bipartisan Act, from Inflation Reduction. There's a group of agencies that's called the Interagency Community Investment Committee, the Interagency Community Investment Committee, and it includes HUD, Treasury, EPA, Energy, Commerce, really all of the agencies that have been able to receive these funds. And our goal is to channel it into the communities. And this entity, ICIC is our nickname for it, has one job, which is to make sure that as we're receiving these funds and deploying them, that there's an equitable distribution, and not just to the end user and the consumer whose homes are being weatherized, which roads are being repaired, but also from the business aspect, making sure that as the intermediaries and agencies that receive these funds are looking for local lenders and credit unions to partner with, that we're saying we need to make sure that we're not just helping Black homeowners, we need to make sure that we're helping Black banks and Black businesses as well, the full 360. And we've been singly focused on this. We've created something that's called a No Wrong Door for small businesses, so people have one-stop shopping. And what I'd like to provide this group in a different forum is just access into some of the players there, because we are very intentional. It's not totally transparent to where you and your audience is sitting, but we've been very intentional about how we're thinking about deploying these funds and nudging our grantees to make sure that they're being as wide-eyed about these investments as well. So that's one. The other thing that we've done to make sure that we are working with MDIs and other institutions is just looking at the same thing that Sandra said, just looking at what our cities and states are doing as well when it comes to our regular HUD funding, and making sure that we are being clear-eyed about when you have CDBG funds, when you're looking at your home funds, these are our affordable housing grant funding, how are we actually incorporating Black businesses and Black lending institutions into the fold and asking the question. And these are things that I know former Secretary Fudge did. These are things that I'm doing when I've traveled the country. So part of this is, when the president came in day one, he signed an executive order on equity. And we have been really doggedly making sure that, while not terribly transparent to many of you here, that as the folks who are in leadership roles, that doing everything we can to make sure that we're staying true to his executive order.
That's so inspiring. One of the things that I've written about in my own scholarship is how the work that you guys do is so important, because you're literally sort of writing the rules for capitalism, and that the regulatory community and obviously those adjacent to it really do help to enable lots of different kinds of opportunities, and it requires an intergovernmental effort. Sandra, I don't know if you want to add to that wonderful sort of overview, but what more can government do, and what's your perspective?
So just in terms of focus on Black communities and Black institutions, I'd like to take a comment that Adrienne made and really emphasize it, and that's the focus on equity. One of the things that was important to me as director and regulator of Fannie Mae and Freddie Mac is really understanding, are our regulated entities doing as much as they can to close the home ownership gap, because the gap when I took office was wider than it was when discrimination in lending was legal. And so we asked Fannie and Freddie specifically to develop some what we call equitable housing finance plans. And these are plans that were designed to identify and then address barriers to home ownership faced specifically by underserved communities. And Fannie Mae has created the Black home ownership journey and the Hispanic home ownership journey. And Freddie kind of combined the two and had kind of the underserved home ownership journey. But at the end of the day, notwithstanding education, because everybody talks about that, what are some tangible takeaways that we could implement? And what I'd say to that is one positive thing that I don't know that many people are aware of, and FHA does this too, is the implementation of positive rental payment reporting. And that's important because when we looked at the Black homeownership journey, many African Americans and just underserved and Black and Brown people generally are renting. And so they're paying their rent every single month, but they're not getting any credit. Many of the people that are renting have thin credit files or no credit files. And so why wouldn't someone get credit for making a rental payment, because rent is looked at as an expense and not a debt? And so we piloted a program where the underwriting systems for both Fannie and Freddie would incorporate positive rental payments on the multifamily side, because both organizations do have multifamily business lines. We have piloted programs where we have a company that is collecting rental payments that are being made by properties owned and backed by Fannie and Freddie. And again, the same is true for FHA. And I think this positive rental payment program is making a huge difference, because we've seen a number of potential borrowers go from no credit to some credit, and then from some credit to a thicker credit file. And we don't have a lot of numbers, but what we've seen so far is that a number of people who've used the positive rental payment reporting have performed better than people that have, marginal credit scores. And so addressing that huge chunk across the board, we think is really important, especially to underserved communities. We also find that updating the credit score model, we've used in the mortgage industry classic FICO for over 29 years. And we are in the process of changing and updating that credit score model to VantageScore and an updated FICO, what we call FICO 10T. And it's important because one of the things that it does is it incorporates positive rental payments, it incorporates utility payments, and many of the things that people are doing today. They are making monthly payments, but they're not the traditional monthly payments. And so making those big changes, we think, is a huge part of reducing barriers to home ownership. And I hadn't mentioned the work that Adrienne and I are jointly doing with the rest of the regulators on addressing appraisal bias, which, as you well know, if you've ever heard of whitewashing your home before you sell it, that is true, it is real. And we're also trying to work together to diversify the appraisal industry. So I'll just stop there.
Well, you really sort of moved us into sort of the final innings as to this question as to what we can do as we think and we move to this holiday about what can not only the government do, but what can the private sector do. I mean, ultimately, when you think about really the mission of creating wealth, I always think about owning a home as sort of the first rung on the ladder, and that then enables you to participate in the larger financial economy, whether or not that be owning your own business or owning financial assets. But that's a journey that involves lots of different actors. So with that in mind, Acting Secretary, I mean, what can our private sector citizens and friends do to really move the dial on the mission?
Right. So I'll say this: be intentional champions for your communities. And I think that the fact you're already in your community working with who you work with, you will probably already meet that definition. But as it relates to how do we make sure we're leveraging generational wealth through homeownership, that we're leveraging the impact on economies, the positive impact on local economies that having housing affordability writ large brings. If you have you can't have a healthy community if you only have housing for very, very low income and the very rich. You need to take care of that miss and middle. You absolutely have to. And we're seeing a lot of that work, just not, that work is not being fulfilled. So number one, being a champion for affordable housing, what do I think that looks like? Sometimes we have emerging developers who may be looking for some pre-development costs coverage or some type of bridge funding to get them to get their deals at least penciled out before they can begin to earn the developer fees. We know that land acquisition, there's costs that are assumed there that sort of impact whether or not a emerging developer or a tenured developer is able to build affordable housing. We know that you all are anchor institutions in your communities, and just really being a platform to share information and access. Just this alone, many people in your communities do not have access to the FHFA director and the acting secretary of HUD, but you do. And one hope I would have is that you would take any of the information you learn here, maybe go to a website, maybe follow up, and become just entities that are sharing information with local businesses and other folks who need it. One of the things that we've been very intentional about is trying to make sure that we're working with local partners who are sharing some of the developments and actions of this administration, because we see that being sort of a core issue. We're in DC. I know I'm here on 7th Street, thinking we're doing a great job. And then I go someplace in the country and they're like, we have no idea, Acting Secretary Toddman, that you are even thinking about, positive rental income. We didn't have no idea that you're thinking about housing counseling as sort of a core way to get to generational wealth and making sure people are aware of how to become a homeowner. So we really rely on all of you to make sure that you're not just showing off what we're doing, but if you care about your communities and you think these tools can help, that you're exposing your communities to the fact that you had these conversations and seeking more information that you can provide. But also, I would say we are here for you. I mean, I agree to participate in this because I know the core role that you all are playing in communities that HUD sets its entire mission around. So I certainly see this as not the beginning, but the beginning and continuation of a conversation on ways that we can have you all at the table when we're talking to folks to make sure that we're being held accountable for the things we want to do, but you all are feeling that you're sharing in this historic moment that we all have.
Thank you so much for that, and these opportunities. I know that everyone involved in this, really appreciates that support and your leadership. Sandra, did you want to sort of take us out of here before the others kind of hop in and they yank me away? Did you want to have or add some final thoughts on the private sector?
One, I want to double down on everything that Acting Secretary Toddman said. We have to work together, and it takes federal, state, and local lenders. We jointly go across this country, and there's a lack of awareness about the programs we have in place and how they work. But we've got to figure out a way to make these programs work, but it's gonna take a lot of work at the local level as well, especially when you're thinking about zoning and city ordinances. And when you're talking about different property types like affordable, the accessible dwelling units, or the manufactured housing where they look like stick built. And so I just think it takes a village, or partnering with companies. Like I read the other day that Amazon has put together a housing equity fund. It's $3.6 billion. They need to be partnering with us so we can make that money go a long way. Again, I want to mention the home loan banks. They buy loans, 1, 2, and they package them and put them in securities. But I also want to encourage the conversations with Fannie and Freddie. They've waived their application fees for all MDI sellers. And again, I don't think we have any NBA members as active sellers. And many of the members will know I used to be head of supervision at the FDIC, so I know how important they are to our community. When I started my career, there were 44 Black banks, and now I don't think there's even 25. And so we need to work together to really address this problem.
Well, you know that you're singing music to my ears. As I said, you know, this program, this initiative has really been inspired by you know, what can we do to really lift and to uplift these Black and brown and minority banks and institutions, and what are the levers, you know, to make that possible. And it was really a pleasure to listen to all of you, to both of you, in terms of the programs that are underway. It is inspiring, it is real, and it's important, even if in many instances it may not always be seen. And so I definitely want to sort of double click the fact that, you know, making sure, or making as transparent as possible what is going on, and how we can all participate, whether or not it be a nerdy law professor or a Fannie board member, or whether or not be the leaders of our government. And so I want to thank you both for your time. We do know that it's very precious. Thank you so much for having joined us.
Thank you so much, and take care, everyone.
Yeah.
Bye-bye.
Thank you.
Bye-bye.
Great. Thank you so much, Acting Secretary Toddman and Director Thompson, for joining, and Chris for moderating that discussion. I'm Worku Gashu. I'm the Vice President of Inclusive Impact and Sustainability at Visa. My team tries to figure out how do we leverage our brand, our products, our technology to drive social and environmental impacts. I want to first start off by thanking everyone who joined us today, prioritizing the recognition of the Juneteenth holiday. I also want to recognize the great work of Georgetown Law and the National Bankers Association. Both institutions are great advocates for the MDI community. As a Hoya alum, Chris, loved to see the work of Georgetown Law in this space. And also want to thank Congressman Cleaver for joining us earlier. Juneteenth marks the emancipation of the last remaining slaves in the United States, and allows us to honor the history, culture, and resilience of the African American community. And it reminds us that we need to continuously evaluate how we as a company need to show up and support minority communities. At Visa, our purpose is to uplift everyone everywhere by being the best way to pay and be paid. And that means regardless of where you live, and who you are, right? You have access to the global economy. And it's with that theme, it's with that spirit that, you know, we are committed to supporting MDIs. You know, MDIs are crucial in these communities and allows these communities to have a seat at the table that historically have not been the case. We are committed in supporting the trajectory of these financial institutions, recognizing the role that they play in providing capital and providing other technical support in these communities. In addition to our MDI research that my colleague Jacob shared earlier in the program, Visa supports MDIs through our MDI Accelerate program, where we're providing assets, tools, and solutions that help these institutions grow and acquire new customers and increase their revenue. We designed this program to really understand, you know, what are the needs and what are the capabilities that we could provide to MDIs to help them grow. I'm proud to share that we've directed over $100 million in deposits to minority-owned banks that will catalyze up to $1 billion of lending in Black, Hispanic, Asian, and Native American communities. Outside of just putting our assets to work, we're also putting our research and technology capabilities to play. So with our research, we're ensuring that some of our top analysts are looking at, you know, the spending momentum and the consumer behavior health of these communities, while also understanding what are some of the technology gaps that MDIs have to ensure that they continue to evolve and support the digital offerings for their customers. Our work is ongoing. right? And we're committed to supporting the vitality and the well-being of MDIs throughout this country. We're at Visa. We're excited to continue to support MDIs through close collaboration with partners like Georgetown Law and the National Bankers Association. Thank you again for joining today's discussion, and look forward to seeing you all soon. Cheers.